All right, so does Elliott Wave work, and if so, how do we use it to make money? I've been doing Elliott Wave analysis since 1987, and I see the patterns work day in and day out. But I think the thing to keep in mind with Elliott Wave is that it should be viewed more as a framework for trading and investment decisions rather than a crystal ball to make predictions. There are times when you can make a forecast and it comes to very close to being accurate, and that's exciting. And predicting where the Dow might be a year from now is an interesting thought exercise. But the real strength of Elliott Wave is to know when it's advisable to make an investment and how to manage the trade, and where you're wrong. In contrast that with fundamental analysis, which if a stock is a good value at 16 and it goes to 12, then it's even cheaper. It's even better value. If it goes to 10, it's even cheaper. But if the fundamentals haven't changed, where are you wrong? How do you manage your risk? My name is Robert Kelley, and I'm the U.S. intraday stock market analyst at Elliott Wave International. Bob Prechter started the company back in the late 70s. He's been writing the Elliott Wave Theorist there ever since. And I'll be presenting his longer-term view and the outlook from the Elliott Wave Theorist publication, the monthly financial forecast, and the short-term update. On the one hand, we think the bull market has maybe a year or two to go. On the short term, flip side there, we may have a big correction first, and both, of course, presents opportunities. First, let's take a look at how market psychology plays a part in market movements. Markets top on good news and bullish sentiment, and bottom on bad news and bearish sentiment. To illustrate this, I went back to the last major tops and bottoms in the U.S. stock market and found the news of the day. So September 20th of 2018, the news from moneyandmarkets.com, which is kind of a mainstream investment website. Investors welcomed a batch of positive data on the economy. The Labor Department's weekly tally of applications for unemployment aid was lower than expected, with claims slipping last week to 201,000. That's the lowest level since November 1969. An economic index from the Federal Reserve Bank in Philadelphia also topped forecasts, and the conference boards of leading economic indicators, which is designed to anticipate economic conditions 3 to 6 months out, rose 0.4%. It still suggests the economy is on sure footing, said an analyst. So let's take a look at what happened on the 20th. That's highlighted in the yellow. And that box there, that shows the closing high for the year in 2018. And a couple of sentiment tools we use. Fear and greed index is that middle bar. That's a very nice sentiment gauge that is available. You can Google CNN Fear and Greed. It's a sentiment gauge. It's updated throughout the day, and I like to keep an eye on it. It's a pretty good proxy for sentiment. And it was at 74 on that day back in September. And the daily sentiment index was at 83. And you can see both of these indicators were very close to the peak levels that they reach. So we have good fundamental economic news. We have trader sentiment at a pretty high level, and the market then goes to a 21% decline. So that just illustrates how bullish news can make market tops. Now let's take a look at the flip side. From December 24th of last year, from MarketWatch.com, which is another kind of mainstream market website, the current dynamic in the market has it set for its worst monthly and yearly decline in about a decade. Amid nagging concerns that the Federal Reserve is normalizing rates too rapidly and that a continuing tariff dispute between China and the U.S. could devolve and lead to a domestic recession, as international economies are already demonstrating signs of slowdown. Also stoking anxiety was a tweet from Secretary Mnuchin to assess the health of the banking system, which raised some questions about liquidity among those institutions that had not previously been raised. So bearish news, and that's what the market was on that day. That was a December 24th low. You made a slight lower low intraday, day after Christmas, and then we had a 26% rally. And you can see the fear and greed index hit the lowest level I've ever seen it hit, 2, and the daily sentiment index was at 4. So clearly, psychology has to be looked at when looking at markets, not simply the fundamental news of the day, because if that's all you trade off, you can easily be thrown off just looking at fundamental news. So one of the things we believe is that extreme opinions shared widely constitute the single most reliable indicator of an impending trend change of direction for the market. So that's basically saying when everybody's bullish, you can get a top because there's nobody left to buy. If everybody's bearish, there's no one left to sell. That's when you get a bottom, regardless of fundamental evaluations. And clearly, markets are not always efficiently priced. I mean, if they were, you would have these nice, slow, trending movements with very little fluctuation from day to day. And obviously, that's not how markets trade. So we can get overvalued conditions and undervalued conditions, both on a long-term basis and a short-term basis. And that's where the opportunity is. So trader psychology is what moves the markets. And the wave principle offers a way to gauge that psychology. So let's start with the basics of Elliott Wave. R. and Elliott was able to identify price patterns that we analyzed to tell us the state of trader psychology. He developed the wave principle in the 1930s. He found that all markets and stocks move in wave patterns. And came up with a comprehensive methodology for cataloging those patterns and telling us where, as an analyst, you look at where the market is in its wave structure, and you can make a forecast based on that wave count. I mean, Elliott was like a genius, as far as I'm concerned, to be able to just look at charts with no computer help and come up with these patterns and weave it into a comprehensive methodology, which is what I've based my career on, basically. So the first simple structure I can't teach a seminar on Elliott Wave here, but just to give you the basics if you haven't seen it. The basic pattern of 5 waves up, we go from a situation where coming off a bottom, typically the market's, everybody's bearish, and then we start to see the rally, see the market go up, so sentiment turns more and more positive. We trace out a 5-wave advance, and then everybody's bullish, and that leads to a top. So in stock markets, normally the long-term trend is up, so usually a 5-wave advance is the direction of the larger trend, and that's what we get in the stock market. 5 up and 3 down typically. So with completion of 5 waves up, we expect a 3-wave correction, ABC decline. So this is sort of the basic building block, if you will, the cell structure of a typical Elliott Wave formation. Now, the interesting thing about Elliott Wave is that it is sort of fractal in nature. You can view it on a monthly chart, you can count waves, or a 5-minute chart or 1-minute chart. So when you break down that simple 5 up and 3 down structure, if you look closely at the internals, in turn, it will break down into 5 up and 3 down. So in wave 1, you got 5 up, 1, 2, 3, 4, 5. And then within this wave 1, you've got 5 waves up, followed by 3 waves down. So that's the cool thing about Elliott. We can look at it on any time frame. My time frame that I work on is sort of short-term and intraday. So I'm looking at 5-minute charts, 30-minute charts, and it works on those time frames as well. So that's sort of the basic concept, the simple schematic of Elliott Wave structures. Obviously, it takes a while to learn the skill set to count waves properly, but just to give you an idea of sort of the simple pattern we look at. So question is, are interest rates going up bullish or bearish for stocks? To look at that question, let's look at different scenarios where the Fed was raising rates and cutting rates and see what the stock market did. I mean, the conventional wisdom typically is if the Fed's cutting rates, it's bullish for stocks. So let's look at some recent history to answer that question. From the peak in 2000 to 2003, the Fed cut rates 13 times, And of course, you didn't know as this was happening ultimately how far the market was going to fall, but you saw the Fed cutting rates, and the general consensus is that it's bullish. And yet we had a 51% decline in the face of all these rate cuts, 13 in all. And in the 2007 to 08 period, the Fed cut rate 10 times, and we had a 58% decline. So the Fed does not stop a market decline or create a bull market. You know, this evidence certainly shows that. So let's flip it around and ask the opposite question. Is a non-accommodative Fed, i.e. tightening, bearish for the market? And let's look at the last tightening cycle. From 2015 to 19, the Fed increased rates 9 times, yet the market went up 57%. So these rate hikes and cuts really don't follow the conventional wisdom that most people tend to subscribe and you hear in the daily news narrative. So the next question is, does the Fed even control interest rates? Well, let's look at a chart that answers that. And you can see in this chart the green and orange lines are the 3-month and 6-month Treasury bill. The red line is the Fed's Fed funds rate target. And you can see it's lagging those free market rates the whole way. So they're adjusting to what the market itself is doing. And you can see we have a nice peak. The interest rates top out late last year and start to go down. The Fed, behind the curve as usual, starts cutting rates. So they are not, leading the interest rate market. The market itself and trader psychology, global investors are what determine interest rates. But even if you could perfectly predict Fed rates and what the policy will be, history shows that the market doesn't always react as you would expect, and that the typical consensus suggests that it will. So for that reason, fundamental analysis is not a great reliable tool in and of itself, if at all, and that's why we like the technical side of things. I mean, when the Fed has their news conferences, the people come on to CNBC and micromanage the statement, look for little changes of words, and it all seems so important at the time, parsing the statement and guessing what might happen next. But really, I just say, why bother? Because the market doesn't react the way that most people think that it would anyway. So with that, I will get into our long-term forecasts, and these come from Elliott Wave theorists and the financial forecast and short-term update. So this is the very long-term picture on the Dow, and it goes back to the late 1920s. And that big decline down to 41 in the Dow in 1932, we think completed a big wave 4. And from that low, it's possible to count 5 waves up as in its very late stages. And if this interpretation is correct, it implies once this bull market ends, like I said, it may be a year or two, we could be in for a very vicious and prolonged bear market. So that's the long-term picture. And let's zoom in. We'll just go progressively closer in time to see what the patterns look like. So from the 74 low, you can see we got 5 waves up, nearly complete. And the 09 low was primary wave 4. And from there, we're tracing out 5 up. And we think getting close to the end, but not quite yet to the end of 5 waves up from the 09 low. But once we finish 5 up from the 09 low, some kind of bear market's going to be due. So here's a weekly chart of the Dow showing you the closer patterns from the 09 low. And the preferred count that Bob is going with now is that intermediate 3 topped in early 2018, and we've got an expanding triangle wave 4 unfolding since then. And let's zoom in a little further and see where we are in that structure. So this pattern calls for a decline in wave E below the December 2018 low, which is Dow 21,712. There is some debate if the rally is over or not, if D has indeed finished. The current thinking is that it has, but we haven't yet seen a definitive reversal to the downside to confirm it. I would say that last low, let's go, this is a chart from yesterday's short-term update showing the wave count that we're preferring, and it's saying that this last rebound high is the top of a corrective rally and that a big decline lies ahead in wave E, again below the December low. I would say that the August low at 25,340, you can see there labeled wave A, that's your big support level. If that level breaks, then I think clearly the uptrend is broken and a larger correction will be likely. So if you're a long-term kind of long-only investor, I would definitely watch that level at 25,340. Another sentiment tool that we look at is called Investors Intelligence, and it's basically a survey of newsletter writers and how they are, if they're bullish or bearish, and you can see this barometer is very close to previous peaks of its own, and those tend to coincide nicely with market tops. So trader sentiment by this measure is fairly bullish and suggests that there's limited upside. I think even if the market does go to a new high, for example, it probably would not move dramatically higher. We just have a lot of slowing momentum and weakening upside strength. All right, so let's take a look at bonds. And the amazing thing about the interest rate market is, of course, the negative rate picture that we've seen develop overseas. And we've had our bond market move higher, I guess, as people were chasing yield around the world. They were finding it in the U.S. So our bond market has had a nice rally. And we think that from the peak, the all-time high in bonds in 2016, that there is a 5-wave decline followed by an ABC rally that is likely complete. And if that's the case, the bond market will move a lot lower, and the interest rates will move higher. And so that's kind of the bigger picture view. ABC up appears to be complete, and then zooming into a 120-minute chart. This is from Friday's short-term update, counting a 5-wave decline, followed by a corrective wave 2 rally that appears to be complete. That sets the stage for a 3rd wave decline. And if we can take out that last low at 161.04, it would be a good sign that the bond market has gone up. So, I mean, the basic thing to me is this whole concept of negative rates. Why would you tie up money for 30 years expecting to get back less than you put in? So that seems to be an unsustainable extreme that is going to change at some point, and rates will have to go up. And if rates come back to positive overseas, I think rates will go a little bit higher here. So just common sense would tell me that rates can't stay this low forever. All right. And here is a chart of the bond futures, and the bottom chart, the bottom section shows the daily sentiment index for bond futures. Daily sentiment index is a very nice service we subscribe to. Jake Bernstein is the guy behind it, and they poll futures traders on a daily basis, ask if they're bullish or bearish, and you can see it hit a reading of 98 back in August. And one technique I've learned, and I'll show some more of these sentiment charts, sentiment frequently will peak ahead of actual tops and bottom before market bottoms. So one technique I've learned that you can apply when you look at sentiment and like fear and greed is you find a moving average or a trend line that has contained the advance up until you get this major sentiment extreme, and then you can wait for the market to break back below those trend lines or moving averages. Because you can see if you were to go short when it hit 98, you would think, well, how much higher can it go? The market actually went up for another 2 or 3 weeks. So sometimes sentiment, you have to wait for it to bleed off before you get an actual trend change. And I've got a few more examples of how I look at, use that DSI tool. So in the case of gold, we think a bear market rally is probably complete. Here's a chart from the February financial forecast that we published showing our expected roadmap for gold. And it was calling for a little bit more rally and then a pullback to complete a bullish triangle and then a sharp thrust higher and then a down to complete a larger B wave advance and then kick off the next big leg down. That was the forecast back in February, and that's what happened. It shows that you had a little E wave decline, a sharp rally. It entered our target zone. The minimum target was 1484, upper target was 1595, so we kind of went a little bit above the middle of that range, and it looks like a corrective rally in gold is complete, and if that's the case, then there will be a decline in wave C below that prior low, which was 1,046. So the picture is pretty negative for gold if this counts right. And here's a daily chart from a week ago showing you kind of the closer view of the internals of waves, this last leg up, 5 waves up for wave C of B, and then a little bit of a downturn. And then let's look at, this is the 120-minute chart showing a pretty sharp decline off this last high, which is certainly raising the possibility that a corrective rally is complete there and that the next big move is down in gold. So that's kind of the view. And here's the big picture roadmap on gold showing a big bull market from the late 90s that ended and with a completed 5-wave advance, A down, B up. And you can see on the right side the schematic showing you where we think we are in gold and what we're expecting. And that is another pretty significant decline in wave C to continue this bear market that's already started. And here's a chart of the DSI on gold, and you can see also how it peaked at 97, quite a bit in advance of the actual top so far in gold. And so you can see I got a 34-day moving average on this chart. And like I said, you find a moving average that's been containing the advance prior to the sentiment extreme and wait for a break of that moving average as a sell signal. And we got that a couple weeks ago. So sentiment-wise, gold has probably had it. And here's another sentiment type tool that we keep an eye on. Commitment of Traders is published by the government, that keeps track of the position sizes, and it shows you that the number of speculators and their commitment to the long side of gold, their net long position, is at an all-time record. And you can see the last time it was kind of in this ballpark, you had that peak in July of 2016, wave A. So the small speculators, which tend to be on the wrong side of the market more often than not, are again very bullish and very long gold, and we think that's another reason why gold is ready to roll over. All right, and silver has a very similar picture of a big ABC rally coming off the low of late last year, and it appears to be complete, and it's set to move lower and take out that low back at 1387 in November. And here is a chart as of yesterday's close with our current wave count. 5 waves up for C and a 1-2 to the downside, ready to break hard lower in a third wave. And we can also see the sentiment picture recently hit quite an extreme in silver, hit 95 on the daily sentiment index, and we've broken below that moving average. And so that's another reason I think that silver and gold are both positioned to move lower. All right, so let's look at the dollar. It hasn't been the most exciting sector of the currency markets. It's been pretty slow motion action, but that could change. We've got what we think is this is the euro daily chart, and we're showing an ABC decline complete, and that would suggest a sharp rally. And this last structure, you can see those converging trend lines. We think that's an ending diagonal wave C, and if that's correct, once you complete an ending diagonal, you get a sharp move in the opposite direction. And in sentiment picture, we had a reading of 9 on the daily sentiment index a few weeks ago, and the market's gone to new lows again. So that's kind of that divergence that you often see where you have a sentiment extreme, the market keeps going a little bit, sentiment doesn't quite confirm it, and then you reverse. So I got a little trend line on this chart, and I think if we were to break above that trend line, a lot of people are going to run for the exits if they're short the euro, and you can have a lot of short covering really drive this thing higher. So, but it's been a steady downtrend, and we kind of need to break that downtrend before a big rally starts. But the dollar index is sort of the flip side of that euro chart. And it's got a 5-wave up complete, we think. A deep wave 2 may have just ended on Friday, and so that sets the stage for a significant decline here in the dollar index. So just to kind of sum up, there is no government body that sets market prices and makes sure markets are appropriately priced. Their markets are moved by human interaction and mass psychology. And so we just think that the wave principle is the best way to analyze where you are in that picture and make value judgments on the market. And since we've got a little time, I thought I would show a few indicators that I use in my work, in my service, in the short-term stock market. And these can be applied, I guess, to a lot of markets, but some of them are specific to stocks. And that's one of the reasons I like the stock market is you've got so many different indicators and tools. You can see there, I look at the Vix, sentiment, put-call ratios, advance decline line, divergences between the indexes, seasonals. I have a thing called the correlation index that I'll show. And so you got a lot of slices and a lot of different ways of analyzing the stock market that you don't have, say, in a currency market. You just have the two pairs. You don't have any advanced decline. You have very little peripheral data like VIX. So the stock market lends itself to a lot of deep dive type analysis. So here's just kind of a simple tool that most software packages are going to have, the relative strength index. And you can see in this chart of the Nasdaq going back to early 2018, going into that top, you can see the RSI on the 60-minute chart was making lower highs as the market went up. And the problem with divergences, you may not top and turn on the first divergence. So that's, again, where I like to use some sort of a trend change tool. In this case, this 50-period moving average that was containing that rally. And after all those divergences, and there was basically 4 of them, and you broke that moving average, and you had a very sharp decline that resulted. And then you can see in the market bottomed sort of the same way. You have a bullish divergence, and that was a sign that that last leg down wasn't going to continue much more. And then once you broke above the moving average, you have quite a significant rally. So that's the Nasdaq, and here's sort of the same picture in the S&P 500. Multiple divergences on the way up, break the uptrend, roll over significantly, and then divergence on the way down, and we had a nice rally from there. Now, another thing you can do with the stock market is you look at the different indexes, different sectors. So like in this case, this is again back in early 2018 at the January top. the Russell was not confirming the S&P on that last leg. And if you look at markets and different indexes and you see a divergence like that, that's a tip-off that a trend change is very, could be close at hand. So you look for those, and then kind of when the outlier index, in this case the bottom one, the S&P, the one that was making the new high, when it breaks its uptrend, that's a signal that the market's likely to go the other way. Okay, another tool I really like to use, and you don't get too many signals with this, but it's volume spikes. I like to look at the SPY, the ETF, because it's so active and it's so driven by market psychology rather than maybe individual stock emphasis. And so when you see these huge volume spikes, that's a good sign that you're close to a bottom, because there's the panic, there's capitulation, stops getting hit, people bailing out, panicking. So you can see on the left side of the chart, you got one right here, and that was the bottom, and then on the far right, coming down off that peak early last year, you had a big series of volume spikes, and that ended up being a lasting bottom. And this indicator just works very well. It's been continuing to provide nice signals. Okay, another tool that's very helpful is looking at the VIX. And this is kind of subtle. This is, you have to kind of know to look for this, but it can be very telling and helpful. So again, going up into that January 2018 top, you saw the market making a huge run to new highs. And you can see on the bottom, I've got a trend line drawn where the VIX was not making new lows. And that divergence is a sign that the trend is running out of steam. And I guess my explanation for how it might work that way is there's smart money who is buying puts and bidding up volatility because they don't believe the rally is going to continue. And of course they can be early, but ultimately that bearish bet paid off. So that type of divergence is very significant, and it can be applied both up and down. So for example, so here's a 60-minute chart looking at that same time frame. And you can see how VIX bottomed in early January, and it was just kind of edging slightly higher as the rally went on, and that just told you the options market did not believe the rally. But again, you wait for a break of a trend line or moving average to signal that the trend change has happened, then all that last bit of buying is going to, people are going to be running for the exits, and that's what happened. And if you see now at the bottom of the chart on the S&P, when it was making that new low, the VIX was not making a new high. And that was a sign that the option market, again, didn't believe that the S&P was going to continue dropping. So that's the kind of divergence I look for to tell me that the decline is probably running out of steam and the market's getting ready to reverse. So that's the VIX, and that's pretty widely available. Then there's the Nasdaq Vix. And the one thing I like about the Nasdaq Vix is there's no volatility products on it that I'm aware of. You got VIX options, VIX futures, VIX ETFs, but you don't have the same complex of instruments on the Nasdaq Vix. So you don't have that sort of shorting volatility play going on independently. So the Nasdaq Vix is truly an indication of what Nasdaq options are doing. And you can see that when the Nasdaq was rising, the Nasdaq Vix was again not making new lows. And the amazing thing is, look how it turned up from that last touch of that trend line. The VIX was rising as the market was rising. So that told you that the options market did not believe that last leg up in early 2018, and sure enough, we had what they call the volatility event, where you had the ETF XIV, the inverse volatility ETF, blew up because everybody had been shorting volatility, and then it all collapsed and went the other way. And just to remind you about the sentiment. This daily sentiment index hit 96% bulls near the high in January 2018, dropping down to 8. So that's how important sentiment is. When you see those extremes, usually the market doesn't go a whole lot more in that direction. Another tool I use, I like to find assets that are highly correlated to the S&P, and when you see them not confirming a new high or new low in the S&P, it's often a telling sign of an impending trend change. So HYG is a junk bond ETF, and it's sort of a risk-on, risk-off proxy. And back in, again, this time frame was late January of 2018, HYG was just not making new highs as the S&P was. And so when the outlier index, the S&P, broke its uptrend, then we had quite a big decline after that. So I've combined several of these indicators into what I call the correlation index. It's a basket of instruments that are correlated, and when you see it diverge, it's a real warning sign for me that the market's likely to turn. So my focus is the short term, and this is sort of some of the tools I use and have in my service. So with Elliott Wave, we've got monthly publications, we've got 3 times a week publications, we've got 24-hour day intraday services covering international markets, currencies, bonds, metals, overseas markets, overseas coverage of E-mini, S&P and Nasdaq. So we've got quite a few publications you can check out if you'd like to. Since we got a little time, I can take questions if anybody has any questions. Sure. Go ahead. Not with me here, but the oil market is just, it's tough. Any wave count in the oil market, I think, is a little bit debatable because it's just not a clear classic structure. Ultimately, our analysts are bearish on oil and think it will go down, but it may not be ready to do it right yet. So, but we do have services that cover oil. I just don't have a chart with me handy. Go ahead. Yeah, let me see if I can pull up. I don't know if I think I can just open a new chart of the S&P. So that last low in the S&P futures, which is what this chart is, was 2775. All right, anybody else? Mm-hmm. Yeah, one of the tools I use that speaks to your time frame is the tick. You ever heard of that? It's a NYSE tick indicator. Well, the tick is just a reading of the net number of stocks trading on an uptick minus downtick. And so when the market's advancing, if it's a nice strong run, that tick number will be surging because so many stocks are participating. But as the rally kind of slows down and thins out, that tick will be making lower highs while the market's making a higher high, and that's a warning of a trend change. Yeah, Yeah. Yeah, yeah, well, like I said, you can look at the VIX. If you see the VIX not making a new low when the market's making a new high, even on a 5-minute chart, you can, whatever time frame you're interested in, you can focus on. If you see the VIX diverging, not confirming, of course it's inverted, but if it's not confirming it, it's a sign that the trend changed at the, and like I said, my theory is that the option market is kind of the smart money. They're a little bit ahead of the curve, and they're hedging ahead of time, buying puts, makes the VIX go up even though the market's going down. It's a sign of a trend change. So that's one tool. Then, yeah, like I said, HYG is another asset that's highly correlated. If that's diverging, that's a sign. Just traditional stuff like overbought, oversold stochastics, RSI diverging. So there's quite a few tools you can look at, and I definitely will show them in my service and talk about them. I have a daily wrap-up video where I kind of go into detail showing the relevant indicators of the day, discussing what I think is, Mm-hmm. Yeah, or I just, yeah, that's the ones I just mentioned. The tick, the VIX, the VVIX is an interesting one. It's the volatility index on VIX options. It's like I mean, think about it, it's like 6 layers of derivative go from a stock to the S&P 500 to options on the S&P to the VIX to options on the VIX to implied volatility on VIX options. So it's just way down the chain, and I look for divergences between VVIX and regular VIX. And so when you see that, doesn't always work, and not every time, but when you see, yeah, at least on my service. So VVIX, VIX divergences are another thing I look at too. Because that can just be, sometimes that thing will just go one way or the other on its own, and it can be a precursor to the overall market. I'd say maybe occasionally you can have these flash crash type things that can be exacerbated by machines, but in general, we believe that humans program those computers using human psychology, and so it's just going to be consistent with and reflective of trader psychology and doesn't really change the wave patterns. I've been doing this since '87, and I can't tell any difference in the patterns in the stock market. So I guess got time for one more. Did you have a question? Yeah. Okay. Yeah, this predicting a decline of this magnitude is definitely kind of a gutsy call. I tend to be more short-term on my own personal time frame. That's what I'm kind of in a 30-minute box, in my service, and I don't even they don't even want me talking about the long term. So I want to see like a 5-wave decline, and we don't really have that right now. A clean, like impulsive 5 down. If I see that, then I'll become a lot more confident that this market is going to go down. So, but it did kind of break down Friday, and like it might want to. So, it's not the best slam dunk bear case I've ever seen. So I'm kind of waiting for a little more evidence before I decided to get too aggressive on the short side. So, all right, one more. I guess we got a couple. Mm-hmm. Well, it's a different environment. I know our time's out, but basically, yeah, the Trump tweets definitely seem to be playing a part, and there's really nothing you can do to get the early word on that. You just have to react to it. So it's a different environment. It's more challenging. Yeah, it's more volatility, which can be good. So, all right, thanks for listening. Appreciate it.